Let's bring in Shane Obata for his take on the market. Shane, first of all, thanks a lot for joining us.
Thanks for having me.
You've said in some recent commentary that the inverse relationship between yields and tech stocks is approaching extreme levels. Unpack that for us.
Just to say, when rates are up, tech is automatically down. Of course, it's not always that simple. So I think it's the same as last year, right? We saw rates risk really manifesting most in the long duration tech sector. So we've seen that again. We're still optimistic that rates are peaking out, specifically on the 10-year yield, though that's not been the case this week. We briefly dipped under 4, and now we're coming back up after the PPI numbers. But I think taking a step back and probably oversimplifying a lot, perhaps this is all just normalization after many years of very weird things happening. So we went through COVID and the world came to a halt, and then we came out of COVID and supply chains weren't exactly ready for the demand that occurred, pent-up demand. And so that didn't help on the inflation front. Neither did the fiscal transfers that happened. And then eventually we got through that. The war in Ukraine happened. That shot commodity prices up again. And I think the world is slowly getting back to normal. So I'm optimistic that in getting back to normal, hopefully inflation doesn't reset higher, which is what I think some people are worried about. And I mean, reset structurally higher. So hopefully we're getting back to that. And then we can just focus on the stock market, on stocks.
There's a graphic that you suggested we put up on a screen, and we'll do that now. It's the NASDAQ Composite Index, and you think this shows the NASDAQ 100 is in overbought territory, i.e. too high. Explain this graph to us.
There's two pieces to the story. So this was highlighted by Bespoke, as you can see on the screen. And they basically said, this level of this kind of overbought reading, this happened about a month ago. I think it was around July 19th. This kind of overbought reading typically leads to a little bit of short-term weakness. However, the main point in sharing this graphic was to say that it's only ever occurred 7 or so other times, 6 or 7 other times.
And that's, if we just put that back on the screen, that's what the red line, I think, is showing us, right? The red line shows us where we are now in terms of the NASDAQ 100 being significantly above its 200-day moving average. And the red line traces back into history. And you can see the other times, the 6 or 7 other times, as you note, that the white line has bumped into that red line.
So the less important takeaway in my opinion is near-term risk after that reading, to say that it's normal after that level of overbought activity to pull back a little bit. But the overarching and more important part is that these kinds of overbought readings don't occur in bear markets. And subsequently, over the course of 12+ months, historically, we've seen much bigger gains than what is normal for the market. So I think that's the main takeaway, and the main reason for sharing that is to say those overbought readings, while they might have some short-term negativity, indicate a broader structural uptrend.